Alright, what's up guys? I hope you're doing well. James here from jamesdforsythe.com, and I wanted to go on a little bit about what happened whenever Paul Warburg, one of the founders of the Federal Reserve, or he's essentially one of the founders of the Federal Reserve, right? He was a part of both the Aldrich Plan and the Glass-Owen Plan, and a few others. He had his own, I think it was called the United Reserve Association bill or whatever it was. But anyways, when he originally came to the United States, one of the major arguments for kind of having a central bank in a way, right, was the differences between the American banking system and the European banking system. So that's part of the reason why he was always a part of so many committees and that sort of thing with respect to developing monetary reform in general in the United States during this time period, which is basically the very beginning of the 20th century. So like 1902 to 1920 or so, somewhere in there. We're going to push out the end date a little bit just to get the whole kind of the first amendments and stuff to the Federal Reserve Act. But regardless, basically he was their kind of, as you could probably tell by the name, Warburg. He's German, and so he was a German banker, came to the United States, and basically was known as kind of the expert in kind of international banking at that point, right? And so basically we're going to talking about Europe in general. So basically in Europe, the reserves were centralized for their banking system. Note issues were elastic, and commercial paper permitting the immediate sale formed the quickest asset of the banks. In Europe, the bill market formed the most important field in which banks sought to employ their liquid funds, while a certain limited portion of their secondary reserves was invested in the stock exchanges in fortnightly or monthly loans under the term settlement system, generally prevailing on European stock exchange instead of the daily settlement system, such as that in vogue with us, right? So basically, one of the biggest problems, as they deem it, we'll say, for the American banking system, was that reserves were decentralized, and so that was probably the biggest problem was the fact that you had, like during the panic in 1907, the reserves were so decentralized that they weren't able to flow throughout the system to where they were needed, and basically you had banks fighting for reserves in order just to survive. And so for one bank to get their liquidity and to get more reserves, they had to do it at the expense of another bank, right? And so that's part of the reason for the centralization of reserves. And then the note issues being elastic just has to do with the fact that they were able to, I think that part's a little more self-explanatory, to where they're basically able to expand and contract like a rubber band, the money supply, with much more ease, so to speak. And then you have the commercial paper part of it, right? So basically banks in Europe at the time would invest in commercial paper, which is basically helping the economy and that sort of thing, investing in the businesses themselves, right? Rather than as his major talking point in the United States, where the American monetary system, when the banks would essentially just put it on call loans in the New York Stock Exchange, right? So not quite the same as doing commercial paper. Well, I'd say probably it's a very more financialized and less kind of direct way for funding enterprises, right? And so whenever he came over here, one of the reasons they really wanted this monetary reform, right, and kind of why he was such a big proponent in it per se, and also like why the biggest problems he saw from it, right? So he stressed the fact whenever he originally came here that aside from the psychological and political resistance, any attempt to establish in the United States a banking system more nearly approaching the European models would meet a serious and insurmountable obstacle in the fact that while central banking systems in Europe were largely built on a foundation of modern commercial paper and bankers' acceptances, those other forms of paper that we were talking about a second ago, these forms of paper were non-existent in the United States at the time. So basically at this time, the United States didn't have a developed discount market, right, where you could discount commercial paper. And that was really the main talking point, right? And so because of this, progress could only be achieved in small degrees, because it wasn't like they could have basically just completely reform the system right off the bat. They had to, the infrastructure wasn't there for them to really do this. And kind of more of an interesting story of when he first came here, there was someone, a world-renowned banker known as Mr. Jacob H. Schiff, who was a senior partner at Kuhn, Loeb and Company, and then basically Warburg confided in him with some of his ideas and stuff on reforming the monetary system at this time, with the whole like centralizing reserves and making it look more like the European models, right? And so basically Schiff agreed with him, it seems. He said he believed that I was misjudging the psychology of the people, right, the American people, right? So basically he agreed on premise, but didn't think that the American people would take such a system anyway, right? So there was a different kind of roadblock there, right? And he said they would never basically accept any system approaching a central bank, because as we talked about in the previous video, Americans were very, very against centralized entities at the time, especially central banks. So yeah, and however, because of this kind of relationship we had with Schiff, talking about Warburg and his relationship with this Schiff, right? Basically, he asked if he could show his paper to someone else called Mr. James A. Stillman, who was president of the National City Bank of New York. And then basically a few days later, Warburg found Mr. Stillman at his desk and was basically telling him like how he was wrong about the American banking system, and that the American banking system was more advanced, and that basically any form of monetary reform would be the European monetary system more accurately modeling in the American side, saying that since the Americans had already kind of gotten past the need for a central bank, they were more advanced and something along those lines, and so it would be Europe who would reform, not the Americans. And then naturally, 4 years later, and we'll just pull a direct quote, so 4 years later, in the midst of the panic, I found Mr. Stillman once more standing over my desk, and when I looked up, he asked Warburg, "Where is your paper?" I said to him, "Too late now, Mr. Stillman." And his reasoning behind why it was too late was these kind of, to undergo any form of major monetary reform, especially on the sovereign level, that takes years of research and years of development, right? There's a lot that goes into it. That's why the whole, in the very beginning of this video, talking about the beginning of the Federal Reserve Act and kind of the whole dynamic, I said 1902 all the way up to 1920. It's almost 20 years, right? Something along those lines. And the reason I say 1902 is because Warburg actually got to the United States in the fall of 1902. And so 4 years later it was in the fall of 1906, right when the panic in 1907 was starting to develop, right when everything started to go downhill very quickly, right? And so basically, it's important to note the kind of general consensus, almost view, in a way, the opinion of monetary reform in general at this time, and also kind of the political backdrop, because you have to keep that in mind whenever you're thinking about things like this in the historical context, is like, what does kind of the general views of kind of the society in general, right? How many times can I say in general in one sentence? But how many times can you basically, sorry, that thought just went out of nowhere, my bad. But anyways, so at this juncture, basically talking about how the United States kind of was functioning politically at the time, because you have to initiate this into Congress, and there's a political aspect, obviously. But basically, the United States Senate was dominated by, as he calls, the Republican Old Guard of Senator Eldridge, and where he was the all-powerful head. And then this group believed in bond-secured currency, and at a pinch, in still more bond-secured currency. In times of emergency, further relief was to come from the Treasury deposits as long as they were available, the government borrowing as far as it had the power to do. As a last resort, when the panic was imminent, they basically resort to clearinghouse certificates, which we talked a little bit about before, to where the banks in or within the same reserve city would essentially just use clearinghouse certificates as settlement, whenever they couldn't get reserves, right? So whenever, say, just for an example, New Orleans would basically, if they ran out of reserves and they had no liquidity on that kind of banking level, they couldn't do settlement between each other. They would essentially just use clearinghouse certificates until they were able to, right? Just kind of keeping that in mind. So there was a lot that kind of went on, and it was very dominated by that kind of specific group, right? And that kind of explains a lot of why everything was so debt-based, especially in the beginning. Not saying it isn't now, but more of a bond-secured currency, which seems to kind of be more along the lines of where we are now again, in a way, sort of. There's a lot that goes into it, but anyways. So there was also another side of this, because one thing I noticed while reading and kind of studying kind of the general consensus views that really played into the kind of drafting of the Federal Reserve System was there was actually a pretty decent kind of socialist contribution to it, like how exactly the Board of Governors was going to be kind of appointed, whose liability are these notes actually going to be. For example, like are they going to be basically like it is now, where Wilson basically conceded to William Jennings Bryan to have the note issue be the liability of the United States government, and then basically the Federal Reserve System is chartered to issue those through the comptroller of the currency, right? So to complete the picture, to get the other side of the story, it ought to be added that there was also at the time a powerful faction in Congress which stood for the theory that the issue of money is the function of the government, and only a few years had elapsed since the champions of free silver had alarmed the world by their 16-to-1 proposal. I believe, I forget the name of this one. I have a video and a blog post about this, kind of going more in depth on the 16-to-1 proposal for the gold-silver ratio and that sort of things. I think I called it it was the crime of 1873, I think it was 73, maybe 93, but I forgot it off the top of my head. But anyways, so basically he's talking about like the Jennings wing, or the Bryan wing, whatever you want to call it, for William Jennings Bryan, right? That part of the Democratic Party and how they played it into the role, or what role they played into it, right? And so, yeah. Now, I'm just making sure I'm not missing any of my little notes. Yeah, basically everything else I have is just repeating something that's already been said, specifically with like the kind of if a bank ran out of reserves or did not have enough, and basically there was some illiquidity in the system, that basically they would have to fix their own problem at the expense of someone else. And basically, because of all of this going on, in early of 1907, Warburg actually published a couple papers, basically giving his ideas on what would fix this sort of thing. And basically, like, we need to have like centralization of reserves. This is the problem. Basically instituting a more pronounced discount market and making that kind of the foundation, and where basically the discount market for commercial paper, as an example, and bankers' acceptances should basically be the kind of go-to market for banks to put their excess liquidity, right, where they don't need it initially. So basically that's where banks should be investing, not call loans on the New York Stock Exchange, right? And that's pretty much where he goes with this. And the titles of the papers, let's see, one is The Defects and Needs of Our Banking System, which was a New York Times Annual Financial Review, which was January 6th, 1907. And then there's Essays on Banking Reform in the United States, Proceedings, which is from the Proceedings of the Academy of Political Sciences, and a few other things, right? So, yeah. Basically, one of the biggest talking points, kind of like a quick review, is there was a big difference between the American banking system and the European banking system at the time. And so Warburg was kind of the expert per se, of the European side. And so he was given or called upon to give advice on many things, especially by Aldrich whenever he decided to whenever he got his national monetary commission. Yeah, I think that's what it's called. Basically, the commission Aldrich made the committee to basically do all the research and all the academic work to kind of really understand what the problems for the monetary system were at the time and what kind of things could be done and how to fix it, right? Which is really kind of the start of kind of the basis of knowledge that the Federal Reserve Act was basically derived from, right? Where basically the differences between the Aldrich Plan and the Glass-Owens bill, which essentially turned into the Federal Reserve Act, was based off of, right? The only differences were the political kind of structure, right? So like who was going to run what, how were people appointed, that sort of thing, right? Was the major difference. But anyways, I'm going to leave that here. So I hope you guys have a good night, and I will see you on the next one.